When you already own property, you only need 30% equity or more to invest in another property safely. Any more than 30% equity unused is what we call lazy equity. If you have at least 30% equity in a property, that's enough to invest in another investment property without any cash. A bank will lend you up to 90% of the value of your property. So if you already have a loan that is 70% the value of your property, you can access the other 20%. If we break that 10% up into a 10% deposit for another property and keep 10% available as a cash reserve buffer, that way we can buy another property and have a cash reserve buffer. So we can invest in property safely with no other cash needed, but also create a cash reserve buffer to help reduce risk and manage the cash flow of your personal situation, but also the property you're buying. When you buy property, we can almost always find property that the rent and the tax benefits pay for everything. In a market that has a good yield, a good rate of return, and there are hundreds of them around Australia, if you know where to look, the rent and the tax benefits can pay for everything and can even leave you a cash flow surplus, which is what we call cash flow positive. It only costs around 5% of the property value to buy a property in stamp duty, legal fees, and some advice fees. When you sell a property, it only costs about 4%, 3 or 4% to sell it in real estate commission and legal fees, conveyances. So there's about 4% cost to buy it, and there's about 3% cost to sell it. So to justify buying a property, we only need to be confident that it's going to get at least 7% growth over the next 10 or 20 years to cover the buying and the selling costs. So if we only need 7% growth in 7 or more years, we only need to be confident that we're going to get more than 1% to justify those costs of buying and selling it. There are hundreds of markets in Australia where the forecast is 5 to 10% per annum. And over a 10-year period, they're forecast to grow by 60 to 100% or more. So it's very easy to justify using your equity, knowing that we should get far more growth than you need to pay for those buying and selling costs.